Every day, dozens of channels talk about strategies they claim to be profitable. But are they really profitable? You've come to the right place to find the answer to this question. In my channel, I will show you the results we obtained by coding these strategies and analyze them together. My goal is to help you make informed decisions in the world of investment and trading by presenting transparently working or non-working strategies. I invite you to the world of financial strategies. Subscribe to my channel now and let's start exploring together.
I use certain terms in the videos, and I'm shooting this video to explain those terms. Now I'm going to go straight to the narration. For example, let's imagine that there is a resistance here, and this candle breaks that resistance. So we thought the price was on the rise, and we said, let's go long from here. We entered long and the price started to rise. It has risen, it has risen, it has risen, and we say, well, that very good, beautiful money is coming. Then the price dropped a little bit, but when I said it was recovering again, it fell a little bit more, but I'm still at a profit. We continue to stand in the position. We are still at a profit. Again, it goes down a little bit, we didn't get out, it went down as it fell, and then it went below the price we were in. Our position, which was initially in profit, is now at a loss. So what are we going to do to protect them? Of course we will stop. Many of you already know this. Now let's look at the last version. For example, let's say we enter this candle again. Let's imagine that we put a stop at a point that can be supported. We put it on our stop. We looked at the position. The price went up. We are profit. 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 But then he came back to our stop. So we didn't make any money. Okay, we don't want that to happen either, but we don't know how far the position will go. We also don't want to lose after so much profit. That's why we also need to set a profit point. So how do we determine this profit? And that's where RR comes in. RR is the amount of money we will win in proportion to the amount we will lose when we stop, i.e. risk-reward ratio. For example, here our stop distance is 1.76%, then we need to get out of the position at 2 times that is, at 3.52%. If we have entered a trade of 2 RR, we will have closed the position at a profit. If you say I'm going to go into the 3 RR trade, of course it can be. When we go out here it is 3 RR, you can increase it even more. So there's no limit to that. After all, it all depends on your will. For example, for RR, if you opened a trade here, you will earn 4 times the money you risk. Of course, there is also the fact that as the amount of RR in a position increases, the probability of a successful outcome of the position decreases. Here you need to find a balance according to your system, but you need to try to get below 2 RR while finding this balance. You need to aim for a minimum of 1.5 to 2. Because otherwise your business will be 50% to 50%, and with the commissions you pay, maybe the money you earn will go to commissions. Because while the probability of winning and losing is 50%, it is not mathematically possible for you to be in total profit. On top of that, because you give the commissions, you will lose little by little. If you don't think about it, I'll show you an example. For example, we opened a position here. When the RR is 1, there is a 50% chance that the price will go up from here. From here, there is a 50% chance that the price will fall or rise by 1.16%. So when you open a 1 RR trade, there is a 50% chance that you will win because no one knows where or when the price will go. If you have figured out why you lose when you use an RR, let's move on to our other topic now. Let's say you open a trade here. The price first fell a little and then started to rise. He got closer and closer to your goal. You are about to get 2 Bs. You were so close right there, but then the price started to drop. It came, and you stopped, but you don't want that. What can you do in this case? In this case you can use break-even. What is break-even? Break-even is, let's say you enter this trade and the price goes up. After the price goes up, you will see if an RR has arrived or not. How do we check when there is an RR? Let's get this down right away. Yes, for example, this position has arrived. At exactly that price, we reached an RR at 27,328. We've made an RR profit. We will then pull our stop to where we entered. So now we will reset the possibility of losing money. Although it no longer reaches our goal, we will not lose when the price drops. We will close this position at ground zero, and break even, harmless. Break even was like that. Now let's move on to the other topic. Let's say you see this graph. The price seems to be making a horizontal and then a new high. Then it breaks that hill here. You said, okay, this price is going to go up. Let me open a long transaction from here. Let's say that after this break, you have opened a trade at the close of this candle. You put your stop, you came here. 2RR at your destination. When we look at it, it has reached your goal in a very short time, but the position is going. It's going up, and you don't want to miss it. What can be done in this case? In this case, we will use trailing stop. Whatever you call a trailing stop, you don't exit the 2RR trade. Instead, you do this, after 2RR arrives, you start to follow 1RR behind. So the price is going up. Okay, we're not doing anything, it's rising, it's going down a little bit after it's going up. But not so much like that. It keeps rising, it keeps going, it keeps going. The price has come this far, but we can't get out of here either. Because after all, we don't know where the top of the price is. So probably after a few candles, the trailing stop with that candle takes you out of the trade. When we look at it this way, we won 7.69 RR in this position. At first it was 2 RR, but since we had a trailing stop, we won 7.69 RR. I'll add a little bit that I determined the trailing stop here is average, with my own eyes. In your settings, these results can be adjusted to be much better, much worse, maybe to go up that hill or something. I've calculated it this way to tell you, the decision to look at right now. Returning to our topic, with the trailing stop, we have benefited from a very large, if not all, trend. Now you're going to say, okay, we've learned it all, and I want to apply it in different markets, but according to some, 3% stop is less, according to some, even 1% stop is too much. Isn't there a standard for this? We cannot say standard, but we can say that the use of ATR is the average of this work when determining the stop distance. What is ATR? If you say, average is true range. Okay, so what does that do? Let me show you right away, from a random place. Let's look here. For example, let's say that you have entered the long position again for some reason. Right there. If you want to determine your stop distance according to ATR here, here's how. You're going to look at this candle. What's the ATR value? 281. If you are trading on the daily chart, you can set your stop distance up to 1.5 times this ATR value, on time frames lower than the diary, sometimes up to 2, sometimes up to 2.5 times. If you don't understand what I'm saying, let me show you right away. For example, we are now in the 1 hour time frame. That's why multiplying by 2 might be good. What was our ATR now? When we multiply 281 by 2, it says 562. Our stop here now is 480. We're going to take it to 562. So it was 561.5. We can say 562. Here we can set such a stop distance. As you can see, it was quite affordable compared to the market. So it's not a distance that will stop us at a moment like this, but it's not too exaggerated, not too far away. Because ATR gives us a measure of the volatility of the market. In other words, it shows how much the price will go on average in the downward or upward direction. We can determine this volatility, as I said, by a minimum of 1.5, sometimes 2, sometimes 2.5, and our stop distance. To be more memorable, I'll also show you an example of the euro-dollar. Look, the values here have fallen much lower. This will be appropriate for the market. Now you will see that you have entered the trade in this candle as it is opened directly. You have entered the long again. We look at our stop distance right away. We multiplied 136 by 2. It became 272.274, but it is not very important. He stopped us here. But as you can see, an extreme candle came across. If you do not want to come across these extreme candles, you can also multiply it by a higher value. If we had done 2.5, we wouldn't have come across this, or 3 or more. It's all about your perception of risk. If you say I don't want to take too many risks, if you keep your stop too wide, you will not stop easily, but you will not easily make a profit. This is a decision you will make. Those were the terms I'm going to talk to you about in this video. If there are other terms that you are curious about, do not forget to write in the comments. If you like the video, don't forget to like and subscribe to the channel.